Hello, welcome to another webinar from us at ING's Global Research Team. I'm James Smith, an economist based here in London. Now, today we're talking about the Fed, who, of course, kept rates on hold last week, causing some investors to question the American central bank's commitment to its inflation fighting credentials. We're going to be talking about what would happen if markets do, if the Fed does hike rates this year. What would happen if it doesn't? What could get it to cut rates in 2027? What inflation outlook would need to get us there, and of course, what does it all mean for the dollar? This is the second part of our summer webinar series where we're trying to look at big market consensus themes and look at how they could be turned on their head. Now, today, I'm joined by two speakers. We've got James Knightley, he's our chief international economist. He's normally based in New York, not today, but normally based in New York. And here in the studio in London, got Francesco Rizzoli, he's our FX strategist, and he's here to talk about the dollar in a little bit. But before we get into all of it, let's start with a poll of what you're thinking about right now. And it's a simple one. Do you expect the Fed to hike rates in 2026? Yes or no? We'll come back to the results of that in a few moments' time. But James, we're going to get into what's going to happen with interest rates in a few moments. But let's start with that meeting from last week, because there's a pretty widespread view out there that Kevin Warsh's press conference has left investors a little bit confused. Maybe there were some conflicting messages in there as well. What did you make of it? What do you think Warsh's premiership holds for the Fed over the next few months?
I don't think anyone has an issue with the result or the decision on its own. The markets were going into last week's meeting pricing about one-third chance of a rate hike. Economists were much more confident that it would be a no-change outcome. But as you say, it was that press conference where there was a sense that going into that, we knew Kevin Warsh was going to try and play down the forward guidance, but perhaps he was more evasive than was expected. And I think it was the lack of a sort of a framework as to what is the Fed's reaction function from him. So that uncertainty led to markets thinking, well, actually, is the Fed alive to the risk of inflation as much as we'd like it to be? And that did see the long end sell off to some extent as well. So that anxiety, that uncertainty, the lack of clarity on the thinking within the Fed has created a bit of a void. And so we've gone from one extreme where he was very anti-forward guidance because he thinks it leads to groupthink, it thinks it leads to this lack of volatility, to one of the other extreme where we've got no clarity, no real certainty of what the Fed is thinking and what the Fed is doing, and that risks going the other way, as in too much volatility. Now, I think the interesting thing actually is post that press conference we've had, despite Kevin Warsh wanting the Fed to speak less, we've had a number of Fed officials coming out and providing their own personal reaction function. And the hawks, unsurprisingly, saying, yes, we should have hiked because of this reason, that reason. But the people who didn't vote for a hike are also starting to outlay their thinking in much more detail. And it is one whereby their base case is that they think inflationary pressures will continue to moderate. But if they don't, then they will have to change their mind and will have to vote to hike. So I think looking at it right now, the market pricing of perhaps a 55-60% chance of a hike in September is not real surprising, given that we have got 2 jobs reports and 2 inflation reports still to come.
James, so we'll come back on to what markets are pricing and what you're thinking for the Fed in more detail as well. But let's dig into inflation a little bit firstly. One of the big issues, for obvious reasons, is oil prices, and gasoline has been above $4 a gallon over the last few days again across the States. I mean, how big an issue is that going to be for inflation this summer?
Well, I think it's more about where we go with oil prices. And right now, there is clearly some optimism that a deal is in the process of being agreed that can deliver supply or resumption of supply through the Straits of Hormuz. So we've got oil prices moving low again. So Brent about $80, West Texas about $75 a barrel. And that's historically is consistent with gasoline prices actually falling a little bit. So yes, we're above $4 a gallon now. But I would actually caution that I think we've got a bit of a dampener coming through in terms of refining margins. So if you remember, we dropped below $70 a barrel very briefly on West Texas. And that is historically been consistent with gasoline prices dropping to $3.50 a gallon. in the United States. We got nowhere near. We bottomed at about $3.85, and we're back up now at about $4.10. So we've had a modest increase, but in aggregate, we're still well below where we averaged through June. And I still think that gasoline can act as a factor that helps dampen inflationary pressures when we get that July inflation report next week. And if we can indeed get a deal, and I think that is certainly what our base case would assume, we're going into the midterm elections in November. There's going to be growing political pressure on Donald Trump to relieve the financial stresses on the US electorate as we head towards that. And that means getting a deal, getting a resumption of flow of oil, and getting lower gasoline prices. So right now, yeah, a little bit of anxiety, but I think that we can still see gasoline prices acting as a dampener in the July report next week. And as I say, I think we can get lower energy prices, and we can also head towards a lower contribution from inflation coming through from that aspect.
Okay, so energy is one bit of all of this, James, but there's plenty of other stuff been happening in the inflation mix. Tariffs is another obvious one. What other drivers are going to be relevant for inflation over the next few months?
Well, I think in terms of that story, we're looking at a number of factors. So we would argue there's four points that can lead to a lower energy story. One is that energy factor. The second one, of course, is housing. Housing is the biggest component of the inflation basket, with a weighting of about 35%. It's got about 42% of the core inflation basket as well, obviously. So given that situation where we've got house prices barely rising 1% now nationally in the United States, and we've got growing evidence of cooling rents, and a growing number of states are actually reporting outright rent falls right now. And there is a lag between that and the CPI component. So I still think that can really help to dampen inflationary pressures, or the headline inflation readings and core inflation readings over the next 12 months. The next point is wage costs. You know, the biggest cost input for corporate America is not the cost of energy. It's not the cost of tariffs. It's not the cost of microchips. It's the cost of you and I. And unfortunately, the cost of you and I is not going up all that much. We know from average hourly earnings, they're running at an annualized rate of about 2.9%. We know from the employment cost index that we got last Friday, private sector wages are only rising 3.1% year on year. These are pretty benign prints. And today's unit labor cost data came out 1.3% annualized rate for the second quarter in a row. That is really, really low. So there's no inflationary pressures of any meaningful sense coming out of the jobs market. And then the fourth point that we make is tariffs. You know, tariffs were seen as the big inflationary impulse over the last 12 months. But we're now arguably in a less onerous, lower tariff rate regime following the nullification of the IEEPA Liberation Day tariffs. And in fact, actually, what we're seeing is tariff refunds. And those tariff refunds are now more than offsetting the actual tariffs raised on the current regime. So we've got a net cash flow boost over the last couple of months, and that's going to continue perhaps for the next 2 or 3 months as well. And that cash flow boost can really help mitigate cost pressures that may be elsewhere in the supply chain. So for me, I still think that we can see some pretty benign or more benign than we have seen inflation readings coming through. And that's, I would argue, is still going to be enough for the Fed to narrowly decide not to hike rates in September. And if they don't hike rates in September, I think that the probability starts to diminish even further of rate hikes later in the year and into next year.
James, just to pick you up there on wage growth, obviously quite an important factor. And the Fed hawks will probably say, well, look, we've got payrolls growth that has been accelerating again over the last few months. Is the next logical step of that reacceleration not a pickup in wage growth? What would you say to that?
Yeah, I mean, I would say, we averaged employment growth of about 8,500 a month between January of 2025 and February of this year. That was incredibly low. Now, we had some better prints for March, April, and May, but the June report came in at less than half what was expected, and we saw 74,000 downward revisions to the 2 months before that. So to argue that we're in a massive rebound in hiring, I think is a little bit of an exaggeration. If we look at the employment indicators, the ISM manufacturing number on Monday, the employment indicator did improve, but the services from yesterday was really weak, back in contraction territory. We're going to get the National Federation for Independent Businesses, the small business sector survey of jobs later on today. That's expected to be pretty weak. Currently, we're at the lowest levels when you ignore the 3 months around the pandemic craziness when people were being laid off dramatically. It's the lowest for 10 years. So I don't think we can say that the survey evidence is pointing to a resumption of huge hiring. So for me, we've got a situation where we've moved from 2022, where there were two job vacancies for every single unemployed American, to a situation today where we're completely imbalanced. There's one job vacancy for every American. The quits rate has collapsed as well. So there's no turnover coming through. So that lack of vibrancy, I think, is apparent in many, many indicators now. So I'm pretty relaxed about the idea that we're going to be seeing widespread wage inflation. It'd be great, it'd be really good, but I don't see it at all.
You mentioned there that the jobs market is more balanced, but one market that is very much not balanced right now is the one for chips and semiconductors. You alluded to it a minute ago. We are starting to see some of those items go up. I mean, here in the UK, the cost of everybody's smartphone has risen quite sharply over the last couple of months. Is that going to be a big driver of inflation?
It certainly gets the headlines, and when you see the iPhone's going to go up $100, Xbox $150, your MacBook going up, all those sorts of things. Yeah, it's one of those big ticket items that people notice and people are aware of. It's not quite as like milk or bread or gasoline, but it's getting there. It's one of those things that people are sort of aware of the pricing around. Now, the counterpoint to that is that the chips that go into it are just one aspect of the cost. Moreover, the weightings within the inflation basket are critical, and that's why I made the reference to housing a little earlier. Housing has a weighting of 35%. Now, if we look at what the weighting of computer and peripheral equipment is within the inflation basket, it's 0.299 percentage points. Add in telephones, smartphones, and other calculation devices, which is a separate category, that's got a weighting of 0.41%. So in combination of all of those tech-related items that are going to be suffering from chipflation, as you call it, it's a weighting of 0.7 percentage points within the basket. So it's very low. So it's got to rise pretty markedly to really drive inflation higher. And the other point I would make is that the US adopts what they call hedonic pricing. So it's quality adjusted. And that's why, if you look at the price of smartphones, they haven't changed over the last 12 months. If you go into a smartphone retailer of choice, you'll see that you pay the same price this year as you paid last year right now. Yet within inflation, the inflation metric is that smartphones have fallen 12.7% year on year in price. And that's because they quality adjust. The smartphone today can do a lot more than a smartphone from 5 years ago. And therefore, although the price hasn't changed, the fact that you're getting more bang for your buck delivers a lower inflation print. So I think, one sort of interesting side point is that, if we start to see the price of smartphones rise, we just don't buy the smartphone, because clearly the Bureau for Labour Statistics don't think the quality improvement you're getting is worth the price. Just buy an older model. So I think, combining that point, the low weighting and the fact that they adopt some hedonic pricing is, yes, the inflation rates are going to look higher, but is this going to drive inflation meaningfully higher that the Fed has to hike? I would argue no.
Now, let's check in with a poll from a few minutes ago, James. Now, markets are fully pricing a rate hike by the end of this year. The audience, however, very 50-50. I'm getting like Brexit referendum vibes here, sort of like 51, 52, 48. So very close call either way, no slightly edging it. Now, James, you mentioned the inflation outlook, what needs to happen on inflation for the Fed not to hike in September. But another consideration here is who is going to vote for a hike, right? Because back in June, the headline was 9 out of the 18, 19 committee members are looking or penciling in a rate hike by the end of the year. Yeah, only 3 of them actually voted for a hike in July. So there is a bit of a question mark, isn't there, as to is there actually a majority among the 12 voters that vote at any one time?
Yeah, I think that's the critical point. I think, when we look at the speeches, the commentary from the officials, and we can try and figure out, we We know pretty well who the 9 are that says they think they're going to hike and who the 9 are that says, well, we don't think we need to hike. And of course, Kevin Walsh didn't submit a submission, and the strong suspicion is that he will be in the don't think that they'll hike camp. So that will make it 10 to 9 on the face of it in June. And since then, of course, the inflation data has been really good, i.e. coming in much lower than expected. We got that 0 core month on month, and we got the -0.4 headline. And of course, we got the jobs number, which was much weaker than expected. So you would think that that helps the argument for no hike, and that's why they didn't hike in July. Now, if we look at those 9 that think that they're going to hike, well, we think that 3 of them are the ones that voted for the hike. The other 6 are non-voters this year. So they're not going to be at the September meeting. They're not going to be voting at the December meeting. They're only some of them are going to come in for the January meeting as we get a bit of a switch up. So what the key story to delivering a rate hike is getting elevated inflation that convinces those that don't think that they need to hike, actually, we do need to hike. So it's not the other way around. It is much more about convincing people that they need to change their view and they need to hike. And that's the challenge. And if we do, as I say, see those 4 catalysts for lower inflation, i.e. The proximity to the midterm elections delivers a deal that delivers lower energy costs for the electorate. If we see the housing story continue to dampen inflation, see the tariff mitigation effect, i.e. the tariff refunds helping offset cost increases elsewhere, limiting the need for higher prices, and of course the benign wage story, I would argue that I would still lean in the direction of a no change this year. And I think that's where the Fed, the voting members of the Fed this year currently are. So it's much more inflation has to justify the higher rate story.
Thanks, James. We're going to come on to Francesco in a few moments. One final question for you, though. The whole premise of this webinar is what's happening or what could get us to rate cuts in 2027. That is still kind of notionally your call, isn't it, from the middle of next year? The whole debate here is really how restrictive are the interest rates right now? And there is a bit of a debate at the Fed, isn't there? Some Fed hawks would point to the fact that we've had that payrolls acceleration. Maybe actually the current level of interest rates isn't as restrictive. What's your view on that, and what could get us to cuts next year?
Yeah, I mean, as the poll just showed, it's a very, very close call, and I think it is a very close. It is going to be a very close call as to whether the Fed hikes or not, because we need to see that real disinflationary trend continue. For next year, in general, my sense is that we're in for a prolonged pause. There's no real need, I would argue, from the way that I see the data heading over the next 12 months, for the Fed to change policy rates. I think we're okay. 375 right now, or 350 to 375, is above where the Fed tells us they think effectively neutral is. They've got a long run target, or their forecast for where the Fed funds rate is over the longer term is about 3.1%, and we're well above that. So that's why I think, we'd lean in the direction, where are we going to go from here after a prolonged pause? Is it more likely to be a hike or more likely to be a cut? Well, when you've got the Fed telling us that they think in the long run the Fed funds rate is going to be 3.1%, I would have to say, I would argue that it's going to be a cut. And that's why I've got a cut notionally in there. With very, very low conviction, we could see rates stay on hold for a very prolonged period of time. Now, why is it also that I would lean in the direction of a cut? Well, again, Kevin Walsh's mindset is that AI and technology advancement is going to be a productivity boost to the US economy, and that will allow the US economy to grow faster without generating inflation, and should, in theory, mean neutral interest rates are going to be lower than where they are today. So that is another argument for a cut. And I think that there is buy-in from the Fed in general. If you remember back in the previous set of forecast updates, the Fed revised up its long-term growth forecast for the US from 1.8% to 2% without changing its inflation number. So I think there is some buy-in from the Fed on the technology investment generating a meaningful boost to the US economy that can mean growth can be faster without generating inflation. And of course, also, looking at the supply chain strains, we've got to hope and think that they're going to ease, i.e. the energy story in the Middle East. That's going to alleviate some of the supply chains and other things, such as fertilizer and other aspects, plastics, etc. And also chips, although I'm saying inflation in the chip story is a little bit overplayed, these things go in boom and bust cycles. We've seen it over the decades in the chip industry. And that's something that the chip companies themselves are anxious about as well, is that we will see a ramping up in supply And you've got to think that the data center rollout, the rampant, frenzied data center rollout, will gradually cool. And that supply chain pressure, which is putting some pressure on other prices in the system, should also abate as well. So low conviction call, but in general, I would lean in the direction that eventually the Fed will cut rates after a prolonged pause.
All right. Thanks a lot, James. James, our chief international economist. Now, let's come on to the dollar. Before we get on to Francesco, who's here in the studio, another poll for you. Where do you see euro dollar in a year's time? We've given you various brackets ranging from below 105 right through to above 125. As before, we'll come back to the answer to that. Have a little think. Put in your answer. We'll come back to that in a few moments' time. Now, Francesco, the dollar didn't really like what it heard. The press conference last week with Kevin Walsh. It sold off afterwards. I mean, I think what we've seen, as James kind of alluded to earlier, is the markets are simultaneously banking on fewer rate cuts. So that was the impact reaction, but also questioning the Fed's kind of commitment to its 2% inflation target. Lots of different things have been driving the dollar this year, but does this tell us that it's rate differentials that really matter again for FX?
Yeah, I think it confirms that it's rate differentials that really matter for FX now for euro dollar. One way to look at it is to look at the standardized betas on a regression model. It's one way us in research tend to sort of try and understand what is currently driving a currency pair. Now, normally in G10 currency pairs, you would see short-term rate differentials being consistently the most important drivers, but obviously that can change pretty rapidly, and we saw it happen in March and April when obviously oil prices took over very rapidly, and for some weeks it felt like that everything that was happening in central banks didn't matter all that much. It was all about the next headline about the U.S.-Iran war. What followed was obviously the headline fatigue, markets really growing more frustration on the back of uncertainty of where this Gulf situation would go. And what happened inevitably was that rate differentials became more and more important. And crucially, that happened at a time when markets started to think that the Fed would be able to hike rates. That was a tangible possibility. So what we've seen now, and that happened well before the sort of like the July meeting by the Fed, was this rise in the betas, the coefficients in our models of short-term rate differentials. And indeed, what we've seen after that press conference that you mentioned in the past week, in the past 10 days, sort of, it's been a situation where oil prices have fallen roughly $15, looking at Brent, and the dollar hasn't really reacted much to it. So what we continue to see is markets really being very focused on the short-term rate differential story, the Fed story. So I think tomorrow's payrolls probably matter much more for euro dollar than the next headline about the US Iran negotiations.
So let's take that one step further then. So rates differentials are what matters. We've heard from James, our view on the Fed. We don't think the Fed's going to hike rates this year, could even cut rates next year. Our ECB call is that we're going to get one more hike in September. What happens when you marry that all together and map that onto your euro dollar forecast?
Yeah, so when we come up with our forecast, obviously we look at a number of variables, and we look specifically at how correlations have behaved and how we think they will behave in the future. And obviously the fact that at the moment short-term rate differentials matter so much, and we think they will probably continue to matter sort of in the coming quarters, then we're obviously taking on board this Fed call, and we're basing most of our dollar views on that Fed call, and obviously on the ECB call as well. So when we plot sort of like the 2-year swap rate differential, which is a very good gauge of markets' expectations for the Fed and the ECB, and how we think those will shift when our Fed and ECB calls sort of like materialize. Obviously, that implies a tightening of that spread between short-term interest rates in the US and short-term interest rates in the Eurozone, and the tightening of that spread should drive euro dollar higher. So we published new forecasts today, just a few hours ago, and we're keeping our year-end target for euro dollar unchanged at 118. We're looking for further gains into next year, obviously on the view that ultimately at one point next year, the Fed will start to cut rates.
Yeah, and let's just check in with the poll from a few moments ago. Where do you see euro dollar in a year's time? It looks like most people sort of generally agreeing that euro dollar is going to go higher. Most of you expecting euro dollar to be between 115 and 119, so a bit higher from where we are today in a year's time. But lots of views out there. Francesco, I also want to ask you about the yen. Very topical this week. We've also got a poll on that, incidentally, which I'm sure will pop up in a few seconds' time, which is where do you see dollar yen in a year's time? So the same question. We've got ranges from below 150 right up to above 165. So let us know what you think about that. But it's been a big story, right? This week. It's very unusual that the US and Japan intervene, or here we have this coordinated intervention. The general vibe on intervention tends to be that it doesn't really last that long in terms of its impact. So if the authorities in Japan really want to get dollar yen lower, what needs to happen?
Yeah, I think you're right. It's very rare that U.S. Authorities and Japanese authorities intervened. Last time it happened, it was 1998, so quite a long time ago. And I think what's important is what Scott Bessent said this week was he is expecting the Bank of Japan to deliver the policy follow up to intervention. And that really tells us a lot on how everybody is very well aware that this is just a temporary fix to a structural issue. And the only way the structural issue of a weakening of the yen, especially against the dollar, the only real long-term fix is obviously faster, larger policy normalization in Japan. And after those comments by Scott Bessent, markets are pricing in over 50% probability of a hike in September by the Bank of Japan. Then any other measure that Japan can deploy in terms of encouraging, incentivizing investing in domestic assets, that would help. But ultimately, and that's the thing that Japan has no control over, is the Fed story. So when we look at dollar yen at the moment, we have a short-term target of 160. We think there's still a bit of room for a rebound in the next few weeks, but then we have it coming back lower to sort of like 158 and ultimately back to 155 in the next few quarters. And that's mostly on the back of our Fed story. Because if indeed the Fed does not hike and then heads into rate cuts next year, then the environment for dollar yen will look much softer. Obviously, if the Fed does end up hiking in September, then it will be quite hard, for dollar yen to trade lower, and the chances that they will have to intervene again will rise quite dramatically.
Yeah, quite a lot of moving parts there, actually. And it's interesting when you look at the poll results here, quite a spread of views, really, as to where dollar yen will be in a year's time. Most of you think between 160 and 164. So intervention and the Japanese authorities' efforts not really working. But yeah, pretty interesting spread of views there. We're going to come into your questions now. We've got a couple of minutes left. We've got one here, Francesco. Quite a good question. So the whole sort of Kevin Walsh's thing is that he doesn't like forward guidance, right? And he's not really telling us anything. So how does that sort of feed into markets, rates, but also FX? If the Fed isn't really telling us what it thinks, if it's more likely to surprise us on meeting days, how does that weigh into the outlook?
Well, it means more volatility. It means more volatility around any data release, because what James mentioned at the start was like one of the issues with Kevin Warsh's press conference wasn't just the lack of forward guidance. We knew he wouldn't be giving forward guidance. Was the lack of indications about what the reaction function of the Fed is at the moment to data. And that is something that now markets are missing. So it's a bit of free for all, trying to speculate what the next data release will mean for markets. And the other thing is volatility associated with any off-meeting comments by other FOMC members. I think Kevin Warsh's plans can make sense if he could fully control, the rest of the FOMC and what they say outside of meetings. Obviously, he cannot at the moment. And so what this means is that obviously, markets have much more flexibility to price in and out, rate hikes or rate cuts at a later stage, and this means more volatility potentially around those events, data releases, and Fed speeches, and obviously the meeting itself for the dollar, for FX and rates.
Thanks a lot, Francesco. Francesco, our FX strategist based here in London. Lots of good questions here. I think hopefully we've answered most of them as we've gone through, and we are up for time now. One final thing, do join us next Thursday for our next webinar. That's going to be hosted by Rebecca Byrne. It's all about AI. How's it being financed? Of course, that's been a huge story recently, hasn't it? But also, how's it being powered and the sort of resources it's consuming in the power grid and everything associated with that. So it's going to be good fun. Next Thursday, there's a link to the right-hand side of your screen now to get yourself signed up, and we'll have more episodes of this our What If Summer webinar series later in the summer. You're already on the list for that, having signed up to today, so keep an eye out for updates on that. All that leaves me to say is thanks to both James and Francesco for joining us here today, and also to you for tuning in. Speak to you again next time. Goodbye.